you were talking about liability-driven investing, and there were some other things that you talked about. I want to talk about what you're able to do that individuals aren't able to do, and in particular, I'm thinking about your asset allocation mix, as well as some of the other things that you were talking about. What sort of, as you think about when you got into the business in '99 versus now, what's happened in terms of the asset allocation mix, and how is it different than, say, I as an individual would be able to invest?
Well, just an example. I mean, we've been able to, I mean, we went through this exercise after the 2000 to 2000, after the tech meltdown. Mm-hmm. And we went very quickly from having a surplus to a deficit. And when we unpacked that, we could see that, first of all, there was way more risk in the portfolio than we thought. And we had the traditional sort of 60-40 equity bond portfolio at the time. Most of the risk came from mismatch between assets and liabilities. So we had a situation there where interest rates went down, so our liabilities went up, mm-hmm. and our assets went down. So it was a kind of the perfect storm. At that time, it was kind of accepted that that's just the risk of being in the pension business. And I thought, well, you know, surely we can manage that more effectively. And so we started thinking about ways to better align our assets and liabilities to sort of take away some of those major risks. And I mean, our previous exposure with derivatives really allowed us to think about the portfolio in very different ways. And mm-hmm. derivatives allow you to sort of break the portfolio down to its component parts. So think about the capital asset pricing model, which so sort of risk-free plus beta plus alpha. So risk-free for us is essentially long-term bonds. Beta is, you know, whatever exposure risky asset you want to get, which you can achieve through use of derivatives. And alpha is just your active management strategy. So the two biggest risks probably most pension funds have is actually equity market exposure and interest rate risk. And those things come from moving to having equities in your portfolio. So if you think about the least risky position we could have is owning bonds, right? But that doesn't produce enough income to actually, the plan will be unaffordable if that's what you have. So if you don't use derivatives, the only way you can get exposure to equities is actually to sell your bonds and to buy equities. So you not only do you take on equity exposure, you actually create a big interest rate mismatch. So if you use derivatives, you can actually do an overlay, so you can leave your money in bonds and then just do equity overlay on top of that. So using interest rate futures, equity futures swaps or options. So that enables, so that's essentially what our portfolio structure is. We have a whole bunch of interest rate sensitive and inflation sensitive assets that hedge our liabilities much more effectively, and then we take on other risks in an incremental way using derivatives to gain those exposures. So that combination is actually less risky than if you had a traditional portfolio. So that's an example of things that we can do that you could not do on your own. Right, definitely.
And what about the alpha component of that mix? Because I know that that mix that you're talking about, it gives you less volatility, but I think you also said that there's more upside as well. You have almost the best of both worlds.
Effectively, what we've done is, so there's three big risks which you're trying to hedge, which is inflation risk, interest rate risk, and equity market risk. So we're trying to control those risks more effectively, and then we're trying to take other risks that are maybe more quantifiable, that if the worst case scenario plays out, it doesn't actually have a catastrophic impact on the plan, whereas those other risks actually would.
Right.
So we enter in a whole bunch of absolute return strategies, which typically would be used in a hedge fund world. So we'll do equity long shorts, credit long shorts, funding trades, and we have a list of about 20 or 30 different things that we'll work on, and we may not have all of them active at any point in time, but it's a diversified portfolio of absolute return strategies. So those strategies themselves actually produce enough return that enables us to take our equity market risk down and still achieve the same level of return. So our equity market exposure is about 35% of the portfolio. Well, most people, it's more like 60 or 70.
Right.
So if we had a big equity down market next year, we wouldn't lose anywhere near what our peers would lose. Now in a big up year, they're going to do better than us, but we're okay with that.
Right.
So it's intentionally making that trade-off.